Well, hello to all of you, and it's very exciting to have this webinar. It's amazing how many people have signed up for it. Literally over 400 people have wanted to participate in this. And so we've clearly got a topic that people are interested in, and we look forward to sharing a lot with you tonight. As you can see, I'm sitting here in a hotel room. I'm actually in Johannesburg and on my way to Japan tomorrow morning. And so I'm just going to be working off one screen. And so it's with a huge amount of excitement that I'm welcoming Brendan Brown, who's also on this webinar, and Lee Rush, who's also going to be part of this webinar. And between the three of us, we're going to be running it and trying to add as much value. So welcome to you, Brendan. Welcome to you, Lee.
Thank you very much, Scott. I'm super excited to be online and to finally be doing something with you again. I mean, we've done a lot in the past, and it's so great to be here and be a part of this team again to bring something exciting to the table.
Fantastic. And Lee, thank you for, where are you, Lee? Dubai or Saudi Arabia? I can never quite keep up with your travels.
I am actually in Bournemouth in the UK at the moment. I have the pleasure of dropping off my youngest at university in a couple of days. And so I'm coming to you from a very sunny UK at the moment. Hello, everybody. It's great to be online with you. We look forward to sharing some important content with you. And it's great to have Brendan online with us as one of our partners who's also going to share a lot of information. We look forward to a great webinar.
Excellent. So we look forward to people participating. And just before we do, the webinar tonight is how to earn a passive income in US dollars safely and simply from the comfort of your couch using technology. And, I think that's really the whole focus. But before we do, a lot of people have probably not used a webinar before. And so what we would ask you is just up in the top, right corner, you'll see there's a little button there, and just type in, where are you from? I'm interested in where people are from. And while we're doing that, I'm also going to be putting up a poll, because I'd love to know what has been your experience of Wealth Migrate. Is this your first webinar? Have you been following us for a while? Are you part of the inner circle? Are you an investor? Are you a wealth partner? And it's just important for us to gauge, because obviously, Brendan asked the question, where's everyone from? As I said, clearly a topic that a lot of people around the world are interested in terms of offshore investing and how to get a passive income in US dollars, with hundreds and hundreds of people signing up. And so it just gives us some context. And, it's always a bit of a challenge when we've got investors and we've got wealth partners that, sometimes you're repeating stuff, but equally for people that this is their first experience of Infinity or Wealth Migrate, some people won't even know, what a multifamily project is. So we're going to have to go a bit back to basics in terms of it. So just for your purposes, Brendan, 34% of people, this is their first webinar, and 30% following Wealth Migrate for a while. So, just be careful of concepts like cap rates, hurdles, waterfall.
No problem. What we'll do is we'll keep it very simple, and I'll show everybody how we create really good cash flow and how we can effectively double our money in about 5 years on a very simple calculation. So by the end of the webinar, everybody will be able to understand how we underwrite deals on the back of a matchbox, and then how that translates into real life actual money in the bank.
Perfect. So we got people from America, Guatemala, Johannesburg, America, South Africa, Secunda.
Is Secunda different to South Africa?
Austria, Zimbabwe. So yeah, thank you for those that let us know where they are. Right. I'd like you to buckle up and join us for the first half, where I'm going to take you through the concept of explaining offshore investing and how one can actually go about it, and quite frankly, how simple it is. I also wanted to share with you just a quick journey and set a bit of context. I've been helping people invest internationally since 2004. I've been doing it myself since 1999. And it was actually Brendan that persuaded me to go to America. I went in 2010. I was so dismayed by the fact that most Americans I met would have happily sold their sister, to try and get a deal. And he said to me, no, look, it's time to go back. And he went back in, I think, 2011 to be exact. And him and I went back in 2012. We actually went with Neil Peterson from Real Estate Investor Magazine. We did, I think it was 7 cities in 8 days, which was ridiculous. I don't recommend it. But what it did do is it helped us really start to get an understanding of the different cities, the different markets, the different partners on the ground. And we then 3 months later did a buyer's trip in August, when we started helping people invest for the first time. That was within 3 months of the bottom of the market. And this was actually a trip that we did our next buyer's trip, which was in October. And you can see Brendan and I actually down the front there, looking as good looking as ever, Brendan. I don't think we've changed at all in what is that, 7 years.
Yeah, if anything, I've just got a lot less hair.
This was actually us with Dolph de Roos. So the guy that wrote Real Estate Riches. We were in Phoenix and we were actually going to the auctions. So in the real heyday when American property was in complete crisis, you used to literally go to the auctions and you could buy properties sometimes for, believe it or not, literally $10,000, $20,000. This was us at the bottom of the Grand Canyon with a guy called Marius. So we both, Brendan and I and Marius, to be honest, work hard and also like to play hard. And this was us having I think it was a helicopter flight actually to the bottom of the Grand Canyon. And then this was actually a picture of Neil Peterson and Brendan right in the beginning with my IPS branding and also Brendan's company, USA Property Investments, which we actually ended up merging together, the two companies many years ago. So we've walked quite a long journey together in terms of it. But before we get started, I just wanted to set some context around our relationship in terms of how Brendan and I know each other. And but in terms of tonight's webinar and how to invest offshore and how to create an offshore income, I'm a very big believer in the golden circle, which comes from Simon Sinek. And most people are always worrying about the how and the what. Okay, so they're going to sit here and they're going to go, how can Brendan help me? What do I need to do? And I always say that you've got to get clear on the why. You've got to get very clear on the why, because then you'll figure out your how and the what. So to understand my why and why we do what we do, this is a picture of me and my dad. It's my first property project when I was 13 years old. And what's really interesting is that my dad's story is one that is almost exactly the same as almost every one of you that are watching this webinar. He was taught to go to school. He went to university. He worked really hard. He got a good degree. He actually became financial director of a listed company. And yet he trusted the financial industry and he invested with the financial industry. And on the 1st of October 2005, my father actually died broke. Now, statistically, most of you don't think that that's going to happen to you. Unfortunately, in England, Australia, and America, statistically, 94% of people will end up just like my dad at the age of 65. Another 5% will be financially independent, which a lot of people wish they could be financially independent. But actually, according to the financial industry, they are 25% poorer than their last paycheck, which to me is just 25% poorer. And therefore, literally only 1% of people, although we're all trying to strive and achieve it, less than 1% of people are actually achieving it, basically. And that's why I, at a very young age, decided this is ridiculous. There's got to be a better way in terms of how we do this. I also, as a young boy, loved computers. This is a Commodore 64, and I learned, back at the age of 6, how to program on a Logo computer. I loved to play the game of Monopoly as a kid, and we always dreamed, why can we not turn the game of Monopoly into real life? And I think Brendan's going to show you today how you can own greenhouses and earn really good passive income. And then growing up in Africa, we were very aware of the wealth gap, the massive difference between the haves and the have-nots. Depending on the different research you read now, the top 1% owns more than 50% of the world's wealth. Depending on where you live, unless you're in North America, Europe, Japan, or Australasia, you're at a disadvantage. Unfortunately, if you're a female, there's a significant weighting in the wrong direction. If you're a millennial, you were born just at the wrong time. And for us, when we did the research, and funny enough, Brendan and I actually did this research in a combi, as a South African would call it. I don't know what's the word if it's not South African, but like a camper van, on the way to John Chin's wedding. I don't know if you remember in Savannah, Brendan.
I do.
We were doing the maths on how many people actually own houses around the world, and we finally figured out that literally 49% of the world's wealth is held in real estate, and yet only 12.9% of the world's population actually has access to that real estate. Now, that's all of you that are on this webinar, including myself. But what's disgusting, and I've already explained it, is that less than 1% of people retire wealthy. And our whole purpose, our why, and why we're even doing this webinar tonight, is we want to empower the 99% to be able to invest like the top 1%. We're going to share with you stuff tonight that previously was only available to the wealthiest of the wealthy. And we're now going to share with you not only the skills and the knowledge, but also the ability to participate. Our vision is to make investing as simple as a swipe of a finger and ultimately to get it down to $1. Now, we're not there yet. And I'm a big believer that, that you don't change people's lives by the next deal they invest in. You change it by changing their habits. And hopefully tonight, if nothing else, if you take one thing away from what Brendan and I and Lee are going to share, is that we want to change your psychology and your habits so that you too can have the wealth that you want in your life in terms of where you're going. Now, the question I ask everyone around the world is, are you part of the top 1%? And this was research that I got literally last month from the Forbes magazine, and everyone immediately goes to the country they live in and they try and look whether they're part of the first top 1%. What's really fascinating, though, is I think there's better questions to ask. As an example, Do you own multifamily in America as an investment? Do you own medical buildings as an investment? Do you own industrial buildings as an investment? I'm just giving you an example. And if you don't own those type of things, even if your income is higher than this bracket, then I don't believe you're investing like a top 1%er. And it all starts with psychology and knowledge, which is what tonight is all about in terms of where we're going. Now, I want to share with you some secrets, which I think are critically important, and these are universal principles. I learned this from Tony Robbins, who did a book called Unshakable. He literally studied 50 of the wealthiest people in the world. And the first principle, there's 4 secrets to wealth, which came out of this book. And the first principle is don't lose your money. Warren Buffett talks about it all the time. Tonight is going to be very much about safety and being risk adverse. The world economy is going to change. We're about to have a hugely disruptive time. And Brendan is going to explain to you tonight why multifamily is one of the most economically resilient asset classes. It's really important that you understand that, because the number one thing is that you don't want to lose your money. Forget about how much money you're going to make. You don't want to lose your money. That's the first principle. The second principle is you want asymmetric risk reward. Now, most people think that you want the higher the risk, the higher the reward. That's what we were taught at school. That's what the financial industry teaches us. It's wrong. The top 1% does the complete opposite. They look to lower the risk and increase the reward. So when Brendan's talking tonight, listen to how he is lowering the risk and increasing the reward for you as the investor. Tax efficiency, very, very understandable. I don't think I need to go into it in too much more detail. And then the one that's most interesting to me is diversification. You know, most people think that they should just invest. I was with a very wealthy guy today, and he says, you know, in South Africa, as an example, it's only 0.4% of the world's GDP. So it's illogical to have all your money in one country if it's only 0.4% of the world economy. And yet people in America, in New Zealand, in South Africa, and Australia, they end up having all their assets in one country. And what the wealthiest people do is they diversify across asset classes, within asset classes, across markets and currencies, and across time. And I want to really emphasize this, because wait until Brendan shares around multifamily and all the diversification that you get with multiple units, multiple income streams, and in this case, multiple different actual projects, which really brings it. Ray Dalio says, all that you need is 15 uncorrelated bets with an attractive array of investments that don't move in tandem, and by doing that, you'll reduce the risk by 80% and the risk-return ratio increases by a factor of 5. Now, quite frankly, that's all you need to know about wealth. We can switch off the webinar and we can all go home if you understood that. But it sums up the financial industry. Now, if you don't know who Ray Dalio is, he built a company that's worth $100 billion with a B, and he's worth a good couple of billion himself. And actually, this summarizes the financial industry for me, because they take a very simple concept and they make it very complicated. All he's actually saying is that you need 15 uncorrelated investments, which means you need 15 investments that are not tied together in attractive assets that don't move in tandem. That's all he's saying. So when you look at Brendan tonight, he's going to share with you, just in their portfolio, I think, Bill, that there's 5 different projects, Brendan, as part of the package. Is it 5 different projects?
Correct, yeah. So we're buying a portfolio of 5 different assets.
Okay, that's my point. So there's 5 different assets that are not tied together. Wait till we make the decision about whether they're attractive assets.
It's so cool.
Sorry, say that again?
No, I was just saying it's so cool because you've got the inherent diversification across geographies, across asset classes, across staff members, across tenants. I agree with everything you say.
It's critically important. And if you do that, you reduce your risk by 80% and your risk return ratio increases by a factor of 5. So you only have to do the first part to get the second part. I'm trying to teach you some of the tricks that the wealthiest people use so that you can take these tricks tonight when we talk about multifamily. Let's talk about the real estate value chain. Most of you are the investor over here and you want to make an investment. There's 16 different middlemen between you and your investment. There are numerous fees. I'm being very kind with the only 4 or 5 I've got on the screen. There's no trust, there's no transparency, and because of the high fees, there's very low returns and low alignment. So what most people don't understand is that there's really 5 simple steps to the value chain of real estate. You've got land zoning, which is when it's greenfield, it's like farmland. Then it becomes brownfield, which is when you actually build a development. Then you've got the investment process. That's where you go out and buy buildings. It might be a shopping center, it might be a multifamily, might be a hospital, but you put a tenant in it. Then you tend to sell to a fund or a REIT. That's how most people make their money. And then you and I come along and invest in listed entities, and we wonder why we battle to beat inflation. Well, the reason being is if you look at the returns, and I don't have time tonight to talk about internal rate of return, but this is internal rate of return, IRR, which is the best way to compare different investments. A land developer is looking for generally a 30% IRR. Now, they don't always get it, but that's what they're aiming for. A developer is looking for 25%, and an investor is looking for 20%. A fund or a REIT is purely looking for cash flow. They're looking for a cash flow. So if you think of a pension fund or whatever, and it's 5 to 8%, and to be honest, I'm being probably quite kind here because it's probably 4 to 6%. And then the rest of us wonder why we battle to beat inflation. And so, if you think I'm wrong, go to my LinkedIn profile, go read all about it. I've got actual articles here of how people make money. This is how the wealthiest people, the people Brendan and I have modeled and learned from for the last decade. I don't know, Brendan, when we met each other, 2006, 2007, but you're very similar to me. We're two peas in a pod, where the fastest way to success is to copy successful people. And
100%
the fastest
agree.
way people make money in property is to sell to a fund or REIT. That's how people make money.
Yep, 100% agree, because they're driven by that small income while we're driven by a higher return, and we want to be further up the value chain. We want to be providing product to them, not offtake.
Exactly. And that's why I ask, if you look at the next slide, I always say to people, well, why don't you go up the value chain? If you know this, why don't you become an investor? Why don't you buy a multifamily on your own? Why don't you become Brendan? Why don't you go and build a new development? And the general feedback I get from people is any one of the array of stuff that's on the screen. How do I protect myself? It's too expensive, too complicated. I don't have the time, the knowledge, the money, the structures. It's too difficult. Sounds too good to be true. And I could probably put another 200 up here, and I'm sure Brendan, with all his experience, could share a lot. So if you're thinking these things, it's not the first time we've heard them, and I guarantee you that these voices might even be going off in your head. And the biggest problem that investors have is that they tend to be localized. They tend to be stuck in one country. Once they start thinking about going internationally or thinking about commercial or offshore property, it's just too complex. It's just too difficult. And that's just about finding the partners in the property. Then you've got to worry about legal, banking, compliance, tax, structuring. And by that point, they just go, I don't know how to do it. And they either go see their financial advisor or they buy a house down the road. And actually, when you look at the principles of investing, there's 8 steps that you need to look for. Firstly, you've got to understand the macro and microeconomic factors of a country. Then you need to understand the location of the property, where it's situated. You need to understand what due diligence has been done. You need to understand the risks. There are always risks. Okay, in every investment, even if you put money in the bank, there's risks. So you need to understand the risks and how to manage those risks. You need to choose the right partners. You need to understand the tax and compliance, the bank accounts and the structures. You need to manage your assets. The fancy word in financial lingo is sweat the asset. And you need to understand the exit. 8 simple steps. Again, tonight we don't have the time to go and teach you all of this stuff, but I wanted to share it with you so that tonight you can be coming across to be able to ask the right questions. Now let's look at some of the mistakes people make. I find it absolutely fascinating. Research came out in the Business Day years ago that over 80% of people that actually lose money, that invest overseas actually lose money. Now the number one reason for that is they make crisis investments. Brendan and I have both met people that fly to London to watch a rugby game and buy an apartment at the same time. They go on holiday to Disney World and they buy an apartment in Orlando. And then they wonder why they don't make good investments, because it's crisis. The wealthiest people make strategic investments. The people that lose money don't have the right information, they don't have the right partners, they don't understand the cash flows, they don't have local and international people they can speak to, they don't understand the costs, and the worst of all of them, and particularly with where the global economy is going, the famous, buy it off plan, put down 10% and you'll double your money in a year, which is just a recipe for disaster. And I would be very careful in Australia, England, or America using that strategy right now. The other thing that people do is they underestimate technology. I met a lady months ago, and I've told the story so many times. I don't know if you've heard the story, Brennan, and she was buying shopping centers. And I said, but are you not worried, like shopping centers are going bankrupt left, right, and center in America? And she said, no, well, Amazon will never come to Africa. And I was like, what? Like we were riding Volkswagens, cars never turned up. And, I've been talking about this for months. And then just about 3 weeks ago, I actually saw this headline, which South African investors have been hurting after the large property company lost 30% of its value. And just by the way, these were all the investors: Coronation, the Public Investment Corporation, Sanlam, Investec, Old Mutual, Stanlib, and PSG.
All the big boys.
Which is really interesting because it's all shopping centers. And they it's inconceivable that people can't understand that e-commerce is going to have an impact on retail. And so whatever you're looking at has to be not only economically resilient, but it's also got to be trend resilient. in terms of where the world's going. And as I always joke, but don't worry, as long as you can put an ad in the airport, you can trust me. Anyway, I'm being facetious on purpose.
So, but it's so true. I just want to chip in there for one minute. Like, there's a reason why we don't buy retail, and I know quite a few of very wealthy partners that invest with me that do buy retail in the UK, in South Africa, and in the US. And I've been telling them for the last 2 years to be careful in retail, and they're starting to hurt badly as of this year. So you're 100% right.
Dude, all you got to do is go to England. Same in America. I mean, my mate in London, like, I literally, to prove a point, he ordered a screw on Amazon and it arrived 1 hour later and it had no delivery charge. I was like, I have no idea how Amazon make money out of delivering one screw in 1 hour. But it's just incredible. So, why would he ever go to the shops,
Yeah, exactly. And the freedom, the choice that's provided. What I found in the US, as you know, I'm in the process of moving to the US. I've spent the last 6 months here. When you're driving around looking at these massive stores, you've got the Targets, the Walmarts, the Best Buys, all of that, and you go to 3 of them looking for one particular thing. I needed a USB Type-C adapter for my new Mac, and none of them had one. And I was like, stuff this. So I ordered it on Amazon, and exactly 1 day later on Amazon Prime, I had it, and it cost me like $18 or something. It was ridiculous.
Yeah. And that's what I mean. You've got to be trend proof. We're going to talk a lot tonight about trends, because it's very important to not only understand the macroeconomic of a country, but also the microeconomic trends and sectors that you're actually choosing. Nelson Mandela says money won't create success, the freedom to make it will. And that's something that I know Brendan shares a similar passion to Lee and myself and the rest of our team, that this is what gets us excited. We want to give people the freedom to be able to make the money they want. And so the question we have to reverse engineer that is that by using technology in the same way as when you catch an Uber. So before Uber came along, I'd arrive at the airport, I would phone someone. They would phone the Taxi Owners Association, who would phone the taxi driver, who owned the car, who phoned the taxi driver, and I'd be lucky 2 hours later if someone turned up. And when they turned up, if I didn't know where I was going, they would literally take me the longest route they could think of. They would overcharge me, and if I ever left my cell phone in the car, I'd never ever see it again. Now I literally turn up at the airport, I go onto Uber, it connects me with a driver, no matter where I am in the world. It's simple, it's seamless, it's trustworthy, it's transparent. It cuts out the middleman, it cuts the costs, and most importantly, it dramatically increases the accessibility. All of us now have a private driver. Well, using technology, what we're going to share with you tonight is with partners like Brendan and Infinity, you can literally go right up the value chain and invest with where previously you had to have millions of dollars yourself personally, and that's even if you could find the deals and or get the credit, the bank debt. And then, the other side of that is the growth. And I know, Brendan, I don't know if you can talk about it tonight, but I know you've done some developments in America. Tonight, we're not going to talk about developments. I know that Brendan and I at the moment are feeling both very risk adverse around where the global economy is going. But when the market cycles are right, we allow people to go up the value chain. And I wanted to sort of, just give a story here before I sort of hand over to you, Brendan, if you give me another couple of minutes. But this is an interesting one, because I think we're in a very similar time. It was back in 2002. We just had September the 11th. I was living in London. England was going to war with Afghanistan. Everyone said to me, I wanted to buy a house, and everyone said to me, oh, you're absolutely crazy. Oil prices are going to go up, inflation's going to go up, you're going to lose your house. And although my mate wanted to buy this beautiful 2-bedroom apartment up on Wimbledon Hill, where the tennis is, it would have been wonderful. It would have been an awesome bachelor pad, great way to get a girlfriend, but not a great way to make money. And we ended up buying this council house, which was on a green in Wimbledon. It was a 3-bedroom house, but we could convert it and make it into a 5-bedroom house. And by doing that, we created multiple income streams. Okay. And even though I lived in the house, which is not a good way to get a girlfriend, but the point being, it's a very good way to make money. And since day one, we've earned more than £1,000 passive income out of this property for now nearly 20 years. And we replicated that over and over and over again. Now, what Brendan's going to share with you tonight is what I learned back at the age of 24. He's just doing it at scale now. Okay, multiple income streams, multiple tenants, economically affordable rents, where people have to stay. No matter what happens globally, people need accommodation. And I just wanted to share this with you because, a lot of people will try and always go for the fancy places and the beautiful houses and the whatever, but they don't make you good money. And if I'd bought that 2-bedroom flat in Wimbledon, we would never have made as much income as we made out of this property. And what I've learned from wealthiest people is that middle-class people and professionals focus on capital growth, and wealthy people focus on income and the reliability of that income. And so how does it all work? And where does Infinity fit in? Well, Brendan's going to explain to you tonight about who Infinity is and what they do. He's going to explain to you about his deals and bringing them to the platform. Then you and I, as global investors, can get to go on the platform and look at both Infinity and the deal. And ultimately, you can participate. You can literally sign up. You can select an investment you like. We don't give financial advice. You make the best decisions for you and your family. You transact online, and then you manage the entire your entire global portfolio in one place. You know, what literally used to take months, if not years, you can now do in minutes. And you can literally look to create global wealth with quality partners like Infinity, with top opportunities, and you can literally get in from very small amounts of money, which I'll explain later, which allows you now really just to be able to focus on the best returns and really use technology to your advantage. And so the question I've got for you is, you know, let's assume that we've looked at the whole world and we've decided America is where you want to invest. Well, what most people don't know, and this is what Brendan and I found out the hard way, is that there's 300 MSAs. Now, an MSA in America is a metropolitan statistical area. Most places like England, you only have maybe 10 or 15. In South Africa, there's only like 10 or 15. In America, there's 300. So where do you start? Do you go top, bottom, left, right, northeast, northwest, southeast, California, New York? And we're gonna talk a bit about that tonight. Also, what do you invest in? You know, have you even heard of multifamily? Most people, if you're not American, never even heard of multifamily. Do you do office? Do you do retail, healthcare, specialty, hospitality, industrial, flex, self-storage, towers? Some of you on this call won't even know what we're talking about. But we're going to share with you tonight, and you can see the footage here and which are some of the best sectors and where, you know, people should be looking at. So to give you some context and to simplify this, Clem Santa, who's one of the world's most leading scenario planners, I wrote a book. I created a 4-dimensional model. I wrote a book, Property Going Global, which he endorsed, and it got published in 2014. And I don't have time tonight. You can go and, you know, we'll give anyone, just type in there Property Going Global if you want a copy of it. But it takes all of his scenario planning. It takes the Global Wealth Index, which is like a global CPI. It brings it together with all the different facts. Again, if you want me to, when we go back to Q&A later, I can show you all the different facts between the best market to invest between America, England, Australia, etc. Why we, you know, one of the reasons why we believe America is attractive. But then not just once you think America is attractive, which markets within America. It then gives you systems from a risk and return perspective. And one of the reasons we like America, we've got multi-layered due diligence systems. We've got, you know, different calculators and ways of actually calculating the returns. And it ultimately comes through into GIDS, our global investment due diligence system. But just like when I catch that Uber, no one actually cares how the algorithms work. And so in simple terms, what it helps people do is know where to invest, when to invest, what to invest in, who to invest with, and how to invest. And that's really what tonight is all about as we share with you. Just some track record in case you're new to meeting who we are. We've now got members in 133 countries. We've done $565 million worth of deals. We've done over $90 million through the platform. We've paid out over $8 million in dividends. And we've got a higher than 70% reinvestment rate, which is something that we're really proud of. And if you want to see what 133 countries looks like, it's pretty much this. We clearly need to get someone in Greenland, Brendan. So if you know anyone, can you help me so that I can get that continent covered?
Greenland and North Africa.
Yeah, and I want to share one final tip for everyone before I hand over, and that's portfolio strategy. What Brendan's going to share with you tonight is not only, you know, what he's doing, but also to some extent how he's done it. And the biggest lesson I've learned, and I started off tonight with habits, is that wealthy people don't become wealthy because they bet on the next cryptocurrency or the next stock or even the next property. It's because they had the habit of consistently finding good investments and then investing on a consistent basis. And that's what we call portfolio theory. Now, you know, I'm happy to share it, and we talk a lot about this in our inner circle, where you can literally figure out what you need to be able to retire from a US dollar passive income perspective, and you can work out what amount you need. So as an example, I want a minimum of 15,000 US dollars. You can literally divide that, or sorry, you have to times that obviously by 12, so you need to get your annual amount, okay? And then you can divide it by, as an example, Brendan's going to show you deals tonight at an 8% cash on cash. You can literally divide it by 0.08%, and you can work out how much capital you need. Now, there's inflation, there's tax, there's a whole bunch of things you need to take into account. But it's simple maths that can put the power in your hands so that you can choose. And a good example was 2 years ago, I did this. My son was 5 years old. I decided I wanted to have the power. I wanted the freedom to decide whatever university he wanted to go to, whether it was Harvard, Melbourne, Oxford, an average university in Australia, England. Now, I'm not saying he even wants to go to university. I'm not even sure if he should go to university in 20 years, but I wanted the freedom to have that choice. And so I worked out how much money would I have to pay per month and for how many years to have the freedom to make that happen. And I just wanted to share this with you because I really think it's important that a lot of people tonight, when Brendan shares, are going to get caught up in the how and the what. And I think if you keep focusing on the why, this is a picture of my son learning, and my why was making sure that I've got the freedom that he can go to any university he wants in the world. And Brendan's now going to share with you a vehicle on how you can do it. And that's for me is what it's all about to be a global citizen. It's to the freedom to be able to live in South Africa, live in America, live in China, live in Austria, or wherever all the people are around the world, but ultimately be able to do it. And I always say to people, becoming a global citizen starts with mindset. So the question I've got for you is, are you ready for 2020? Are you ready for the next decade? And hopefully tonight we're going to share with you some information. So I want to give you just a couple of tips, and then it's time to hand over to Brendan. And I've not done too badly because 2 minutes over my time here. But one of the things we looked at right in the beginning, so you can see this research is a little bit old. It's from 2015, 2016, but it doesn't matter, because what we looked at when we did to start off with was we wanted to look at where the major hubs were from a airport perspective. Then we also wanted to look at the top landlord-friendly states. So you can see there that Oklahoma is one of those friendly states, and it's very important that you choose landlord-friendly states, because in America, some states protect the landlord and some states protect the tenant. Now, obviously, you want to be in states that are landlord-friendly, and I mean, it blew me away when I went to America with Brendan, when they've literally got things in the right states called put-out crews. Like a put-out crew is if you don't pay the rent, someone comes and puts your stuff out on the verge. Okay. Now, I know a lot of people around the world are horrified, but the bottom line is I love the fact that your capital is being protected. And then also,
I'd like to say two things on that very quickly, Scott. So the first one is it's a very, very important risk analysis on the rule of law that protects you as a landlord. Because in South Africa, a quick story, one of my partners, you'll see a photo of him in a second, he bought a property in possession 5 years ago in South Africa. He was in court yesterday the whole day. The guy still lives in the property. So that's the one side of the coin when tenants have more rights than landlords. The other side of it, like Oklahoma or like Atlanta, where we do a lot of business, is when we do put out a tenant that hasn't been paying and they haven't been holding up their side of the deal, is they have a place to go. So they've got social housing infrastructure in a first world country that when you're putting them out on the pavement, they're literally going to go down the road and go get a free house, a Section 8 house that's funded by the government because they don't have money to pay their rent. So it's not like I'm putting them out on the street forever. So it's a very fundamental difference to understand.
And again, it's, having invested and had the privilege of investing in first world countries since 2002, I can't tell you the peace of mind when you know that your assets are being protected. If you need to kick tenants out, you can. And people laugh at me, but I am half Zimbabwean, and I still own 3 farms on paper in Zimbabwe. So let's move on. And the other thing that becomes critically important is looking for high growth cities. Things like population growth, etc. But these are just overall slides that we used, and I specifically chose these slides. You can even see it's got our old branding on it. I specifically chose these slides from years ago because these were the years when Brendan and I were actually trying to understand America. Like, we didn't even know where to start, how to find. It's all good and well to find the right partners, but where? And this is the type of research we did. But what I wanted to share with you now was what I was really, really grateful for Brendan to do is he sent me a whole bunch of research. And what I would ask for, Brendan, and you should be able to see my screen here, I purposely didn't go and cut this out, but Brendan sent me literally 14 different documents. Now, if you're interested and you want the latest material, Brendan, I don't know if I'm allowed to share this actually, because you sent it to me. I don't know.
Yeah, this is insider trading, Scott. You can't share this with everybody. No, man, I'm joking. You can absolutely share it. It's everything that's available online. One of the things I love about the US in particular is they've got so much data that it helps you make educated decisions. And one of the great things about it is real estate is the only real place that you can really deploy insider trading strategies where you can learn and trade within a system without anybody giving you hassles about it. So it's very pro business. And the data that we've got is freely available to everybody. I just know where to look for this stuff. And because I'm always in it, what tends to happen is a lot of that data comes to me because I'm living and breathing it every single day. So I'm always trying to find, well, what's going to affect me in the future, and also what's going to affect my deals that I'm in right now. I mean, we've got almost $200 million in deals that we actively manage right now. I want to know what's going on in the market now and want to know, should I be planning an exit? Should I be planning a refi? Should I be planning to increase my rent? How much can I increase my rent by? So we're using a phenomenal artificial intelligence system that almost sets pricing like Amazon does on their stuff for rental. And because we're using that system now, we're getting much higher rental rates than we were getting in the past. So we're using all of this information to be able to make educated decisions, because it's all about the knowledge and how we apply it. And we're looking for risk. And if I can offset that risk because I know a little bit more than other people, then that's great. But the phenomenal thing about it is, with the internet, we can share it with everybody openly and freely, and I absolutely encourage everyone to ask for it and to read it.
Yeah, so just a couple of things here is that, I mean, I've specifically stopped on the contents page. You can see all the different transformation things that are happening. You can see, the different capital markets. You can see the different markets to watch. Over here, you can see the expected best bets, the issues to watch. You can also look at the different property types. So, we're talking tonight about multifamily, but you can, even look at the different sectors. Now, just because it's in here doesn't necessarily mean it's gospel. One of the things that it's always good to not necessarily go with the trend. However, as Brendan just said, knowledge is power. You need to have access to knowledge. So for those of you that are part of the inner circle, I'll just share it on the WhatsApp groups. I'll figure out with Lee, for those that are watching the recording or whatever, how they can get access. But for those who are part of the inner circle, I'll put it on the inner circle for everyone. So I'm not going to go through this. I don't know, Brendan, if there's anything in particular here that you'd like to point out.
No, I mean, there's a lot of information over there. I think if anybody's interested, let them go through it. But what we'll do is take them through a deal that crystallizes a lot of the research that's built into all of these documents, so that you can actually see it in a more practical sense.
I'm literally just going to click on them so people can see. So you can see the CBR. So we've got PwC, CBRE. You've got, this is about the area. So this is actually Oklahoma. So Brendan's going to talk about this, and a market family report. So for those left brain people, people like me, right brain, I'm like, Brendan, give me the 5-minute video. Left brain people, you can read this for the next 6 years while I'm watching the Rugby World Cup. And then you've got all the cap rates and what's happening with cap rates. You've literally got, there's so much research here around all the different classes and sectors. I know Brendan's going to go into this in more detail, but I just want to share with you all the information that I'm going to be sharing with you. You can see what's happening with cap rates over time. Again,
by the time you've worked through all of that stuff, you will be an expert on the US market. I can tell you that much.
Well, I mean, here's a whole report just on multifamily. You can see the outlook here, which is from Freddie Mac. It's one of the biggest lenders, also on multifamily. So, I mean, we promoted this webinar is that by the end of it, you'll know how to build a passive income in US dollars, and you'll know a little bit about multifamily. Well, if we could spend the next 6 hours educating you on everything that's in these documents, but we're actually just going to figure out a way to share it with you. And as I said, the people on the inner circle will just get it directly on the groups. Anyway, you can see all the different information. So coming back to where I was, really what we're excited now is that you can literally go to the current deals. You can go to the website and you can literally go in and log in, and Brendan's deal, the deal is there. And with that, Brendan, I actually wanted to hand over to you, just while I log in, just so people can actually see here quickly. I wanted to hand over to you because what I'd like to do is to take through an understanding of multifamily. Obviously we've discussed it, but I want to go a bit deeper into it. And then for those that want to, actually understand it from a deal perspective, and remember that, we in terms of what we're doing tonight, it's about education. But for those that really want to understand from a deal perspective, we're then going to run through a deal and the pros and cons of the deal, the due diligence, and everything else, so that you can literally understand a live deal and what is possible. So if you literally log in here, you've got the Oklahoma Class B portfolio. You can see Infinity is the sponsor. You can see due diligence is done by Infinity. You can literally click on it. You can go and read all the information. And without further ado, I'm going to hand over to Brendan and make him the presenter, and then Brendan can take us through what we would need to know. Sorry, just before I do that, Brendan, you can actually go in here. You can read all about the risk ratings. You've got all the different documentation, et cetera, et cetera. So there's a lot of stuff that's here, but the purpose of tonight with Brendan is that he's actually the partner. And I always say to people, you often think you're investing in property. I personally think you're wrong. I think you're investing with the partner. And what we're really excited about is hopefully we've shared quite a lot tonight, we've walked a long journey together, Brendan and I. So, and I want him to take you through that so you get a feel for him as a partner, for multifamily, for Infinity, and for the opportunity that he's going to share with us.
Thanks so much, Scott. I really appreciate that, and I'm really excited to share this with you because it's been quite a journey. And just as a quick run through, I know we've got a short amount of time left. I just want to tell you a little bit about who we are so that you can get some context on how we've been able to put this stuff together. So I'm there on the left. That's me. Kevin Harris is my partner that I started Infinity with. He was actually my first investor that partnered with me in US product way back in 2010. We bought a little condo together for $34,000. We then fixed it up and sold it, and we made a bit of a profit, about $8,000, and we did it again and again and again. And before we knew it, we actually bought one of the houses. I saw you had the buyer's trip there. I remember when you sent me a video of the house that I bought sight unseen, because my daughter was actually being born on that particular trip and I couldn't make it, and you went and had a look at the house for me. And that was the first house that I've actually bought in partnership with Kevin for about I can't even remember, $110,000 or something like that. And Jared Coleman on the right there, he joined the Infinity team when I started it in 2016, and he's built over 9,000 units in Sandton and Bedfordview in South Africa. Built a very big portfolio. They're very independently wealthy as well. And he realized 4 years ago that he'd built a very big South African balance sheet, and it could get wiped out very quickly if he wasn't careful because of the political and economic risk that's going on in South Africa at the moment. And he said, look, he needs to build an offshore portfolio, and he joined the team and started helping us do that, and then we did. So you went into quite a lot of why, and I thought it's quite funny that you started there. I started there when I prepped this as well, and neither one of us actually shared any notes before the presentation. So it's phenomenal that you did that, because my biggest why is about building global freedom. So I want the freedom to be able to come and go around the world as I please. In order to have that, I need to have time freedom. I need to have financial freedom in a currency or a basket of currencies that's not going to get wiped out very quickly. And I need the freedom of choice to be able to, when I've got that income, I've got the freedom of choice by default to be able to do what I want, where I want, with whoever I want, anywhere in the world. And what I wanted to do when I built Infinity was to provide that global freedom for myself, but at the same time, be able to entrench myself in the one thing that I truly love on business side, which is property. And the only way to entrench myself in it is to absolutely throw myself into it in the deep end. I had a lot of property experience already. I'd worked a lot with you. We'd bought a lot of properties together. And over the years, I realized my love for it. And if I was entrenched in it, then I could get access to deals. I could get access to people. Because if you're not living and breathing it every day, what tends to happen is the good deals don't land in your inbox. They land in somebody else's inbox that is connected in the network. And I needed to be in the network. So to build that, as I knew I needed to build dependable US dollar or offshore cash flow. Because I was living in South Africa, I didn't want to be rand prisoner. I wanted to have US dollar cash flow so that if I wanted to go live in Bali or live in Australia or live in the US or live in Canada or whatever the case may be, I would have the income in a first world currency where I'm not going to be behind the curve in a third world currency that's at the mercy of what's going on in the world today. So dependable US dollar cash flow was my goal, and in order to do that for myself, as I had to help a lot of other people get exactly the same thing. So my dependable US dollar income became equated in my mind as my freedom. And I just wanted to help other people get the same thing. So how do we protect ourselves and grow our wealth and offset these massive global economic and political threats? And the reason I say these global and economic and political threats is if you've got US dollar income, you can choose what you want to do anywhere in the world without having to think about land expropriation, or they're going to take my stuff from me, or what's going to be the effect of Brexit, or what's going to be the effect of a new regime change in Australia or in China or anything like that. As I want to be free from a personal perspective. Does that make sense?
Yep, no, 100%. And like I said, it's actually a psychology more than anything else. And once you've got the psychology, then it's about the execution of how to make it happen.
Absolutely. And what I did is I found the vehicle that's got the lowest probability of it being disrupted, and that is multifamily apartment blocks in America that are at scale. So when I say at scale, it's got to be more than 100 units, with the right debt, with the right management, and you'll be absolutely future-proof. The most important thing for me is exactly what you said earlier, is the risk that's associated with a deal. I don't want to be buying retail because the risk is high. I want to buy stuff that I know over the long term is going to be resilient, that it's going to be able to ride out waves, that you can ride out a financial crisis like 2008 without losing your money. So these long-term trends are very, very important. And as Warren Buffett said it, number one, never lose money, and number two, never forget rule number one. And it's so, so, so important. So when I go into detail now, this is the high-level stuff. I'm going to go into detail on a particular project to show you an example of the level of detail that we go into in our due diligence in order to make sure that we're not going to lose money. We want to know the income's real. We want to know the assets are real. We want to know there's no deferred maintenance, or if there is deferred maintenance, what is the cost of that going to be? Do we take it into account? How do we structure our CapEx, which is the capital expenditure on the property, to ensure that we don't end up in trouble? What are our reserves that we hold so that we can always plan for when we have to paint the place, when we have to have a new roof put on? If a air conditioner breaks, we've got the money in the bank. We don't need to go scrounging for money. So it's extremely important to remember these rules. And then I just want to do a quick example of the difference between South Africa and the US. I won't spend too much time on this. This is more about the numbers. This is not the reasons why you should move money. This is saying, well, if I'm looking at a comparison, and I'm using South Africa as an example, we've got people from all over the world. Obviously, apply this to your own currency and your own situation. But in South Africa, if I had to buy a normal property, a normal buy-to-let property with a 30% deposit and borrow money at the prime rate, which is more or less 10%, and I take into account the debt, the rates, the levies, the taxes, the management, generally, a normal property, you're going to be negative. We've got this great term, negatively geared. I'm like, well, that means I've got to put money in every month, even though I've got a tenant. It makes no sense to me. But anyway, people are doing this all day, every day in South Africa, and I call it the hope and pray strategy. And eventually, in 3 years, 5 years, somewhere down the line, you might be positive cash flow because you've had a few rental increases and nothing has gone wrong and everybody's paid on time and you've never had a vacancy and you've never had to fix anything, and all of these great things that you put into a spreadsheet that are never actually real. And then I've realized there's a different way. And then even if we take into account that everything's great and we had inflation and we had capital growth, if you take into account the inflation rate and the devaluation against the dollar, and you did the numbers, Scott, you know that over the last 30 to 35 years, we've averaged, no matter which government was in play, a 6% devaluation against the dollar, because we have to be an export country. And in order to maintain our competitive advantage, we've got to always devalue our currency. Then when we do finally sell, when we think we've made money, with high exit fees, with agents commission, capital gains taxes, other taxes, you've got to fix the properties, all sorts of stuff. So South Africa, if you look at a benign standard investment, and then you've only got one tenant in one property, and if that tenant doesn't pay, you're paying on top of the negative gearing. I think it's absolutely terrible. So if we take the same sort of numbers and we say, well, if we bought $1 million property in America and we put down the same deposit, a 30% deposit, which is $300,000, and we take into account all the expenses and the debts, and just trying to see how do I move the webinar control panel so I can see my screen better. So anyway, we take the same income and we end up in a situation, because we're getting better debt, we're doing nothing else different, we're simply getting a better interest rate. We all of a sudden have $25,000 a year positive cash flow on our $300,000 equity, which was the cash that we put down to buy the property, which means we got cash flow from day one. So in South Africa, where I've got no cash flow or I'm negatively geared and I'm paying in the US, I've got positive cash flow. And then because I've got what we call the 3 magic beans, I can depreciate the property over 27.5 years. So I've got a fictitious expense line item that I write into the bookkeeping of the property that effectively wipes out the tax on my positive cash flow. Then I can receive that cash flow and have no tax liability. And then when I do sell, I've got a 1031 exchange where I can defer the capital gains tax. I can take the IRS's money and with my money and roll it into another property and keep going. It's phenomenal. And when you compound that over time and you say, well, finally 20 years, 30 years down the line, I want to exit. Well, Trump, be the man what he is, he dropped the corporate tax rate from 35 to 21% in 2018. Obviously, the man's a real estate guy. He kind of knows what he's doing, and he put in place some phenomenal taxes for property owners. And as a result of that, when I finally do want to exit, if I'm paying a 21% tax, well, that's pretty damn reasonable as far as I'm concerned, especially if they allowed me to take my cash flow without any tax and do a 1031 exchange if I sell. So let me give you a bit of history on who we are very quickly and what we've done. We built this 263 multifamily apartments in Kingsport, Tennessee. Our total project cost was 33.8 million. We sold it for 38.3 million, and our investors made a 31% internal rate of return, or ROI, over about an 18-month period. We also like buying medical, so the two most resilient asset classes in the States are multifamily and medical. We bought this Fresenius Medical Care Center for 4 million. It's been producing cash flow now to our investors for about 18 months, and we sold it on a 5.5 cap rate for 4.237 million and made a 15.4% return. We bought the biggest cotton mill in America when it was built in 1902 or 1903, something like that, and we're converting it to 307 luxury apartments. We got all the plans in place for that development. We got it shovel ready, and then we sold it to a developer. We paid all in, I think it was around 6.5 million, and we sold it for 9.5 million. So we did very well. We've got 86 apartments in Atlanta. We've got another development, luxury apartment development in Sarasota. Development is not for everybody. You'll notice that even when we do developments, we do it in the genre that we really like. You'll note there, the one on the right is an office center. That particular office center was a single investor deal where it was a windfall. It landed on our plate. It was actually owned by a South African bank, and we had a buyer for it, and we just did a trade. We never put any of our personal money in, and you'll note that on every deal that I believe in, we put our personal money in from Infinity side. We've got another double net lease dialysis center in Augusta. We've got another 140 apartments in Alturas. We just closed on another. Alturas is in Atlanta. That one's currently producing 12% cash on cash. So when we bought it, we were at 8. We've owned it for a year, and we pushed the cash flow up to about 4%. So our gross distributions at the moment are 12% cash on cash to our investors, and we pro forma an 8. It's doing phenomenally well. We renovated the entire thing. We've rolled out about a $9,000 per unit renovation on the interiors as well. It's been a phenomenal project, all while we've been collecting cash flow. And then, just as a bit of a comparison, if you had to just invest in the standard REITs versus the S&P 500, the S&P produced whatever it was, a 5.5% compounded return, and REITs produced an 8.7% return. And REITs are governed primarily by the stock market movement and not really by the underlying properties. And we're the people that provide product to the REITs, which is phenomenal. So I think that comparison shows you that you don't necessarily want to be in a standard stock or equities kind of position if you can be in income producing multifamily. And the reason why is very simple. It's the most risk resilient asset class in the world. It's the biggest commercial asset class in the world. Last year it traded, I read certain statistics, and it varies depending on where you read, but anywhere between 350 and about $380 billion, which means that there's a lot of liquidity for exit. So there are a lot of buyers for stabilized, good quality multifamily projects. And multifamily is effectively just one block of flats or apartments under one title deed. So the difference is in South Africa, for example, or in the US as well, as if you're buying individual apartments, that would be condos or sectional title. This is not that. We're not buying individual apartments. We're buying a block of apartments under one title deed, and it's for rent product. So we don't have any other owners in it. We own the entire thing. We control the entire thing. And as a result of that, we have a diversified income, because if we've got, in this particular project, for example, we've got 827 units, which means we've got 827 income streams. And we've got that 827 income streams spread across 5 different assets in different geographies, with an average of about 4 of them are between 100 and 150 units, and one of them is very big, which is 360 units. And as long as it's affordable accommodation, this is the basic human need, which means if we're in B-class assets, it's one level above C class and one level below A class. And let me just give you a brief description on what the differences are. So A class is tending towards the luxury accommodation where you're renting to renters by choice, not by need. So it's the doctor who's renting from you, and there's a massive movement towards renting by choice because of the optionality and the freedom that it gives people, especially in the US, where the trends, even though interest rates are really, really low, people are still not buying properties as fast as they used to, and they're choosing to rent. And they're choosing to rent in the baby boomer sort of demographic and in the millennial demographic, which is phenomenal because of the freedom of choice that it gives them. And what's extremely important here is the A-class stuff that's a renter by choice. Those are the guys that get hammered really hard in a reset of the economy. So why? Let's say they're renting for $3,000 or $4,000 a month. If the guy was earning $12,000 or $15,000 a month, if his income goes down because he loses his job or he's got to find another job or whatever the case may be, he tends to move out of his A-class product and into B-class product, something more affordable, more at $1,000 a month to $1,500 a month. And then C-class product is the next level down, which is what we would call very much renters by need and not by choice. They're the guys that maybe it's a one worker family, or they don't have jobs at all, and it's Section 8 housing. So it's very much low-end worker guys that are earning $2,000 to $4,000 a month, and all they can afford is a $500 to $1,000 a month kind of rental. We don't really like C-class product unless there's a very big value add play and good income on it at the same time. What we love is B-class product, where we're getting the benefits of the average American person that's working. I mean, we're talking a population of 330 odd million people in the US, and the unemployment ratio is 3.8 or 3.9% or whatever it was recently. So you've got 300 million people that are working and earning a living. And of that 300 million people, the average person, if we're providing product to that level of person and nobody can build competing product to us, we'll always be safe because it's affordable accommodation as a basic human need. And if they're earning $5,000 to $8,000 a month, they will always be able to afford $800 to $1,000 a month in rental income.
The other thing, Brendan, that we learned the hard way, you and I, even with Section 8, is that often the numbers look very good on paper, but by the time you've had vacancies and bloody maintenance and all that, and it's not just in America, it's all over the world, that low-end stuff looks good on paper, but I always joke there's a difference between a paper yield and a real yield.
Absolutely.
And then the A-grade stuff is very aspirational, and there's a beautiful word in America called curb appeal, which is basically ego, but it doesn't actually perform as well from a cash flow perspective. So I just want to put the two ends of the spectrum.
100%, and I'd like to add one other thing to it as well. Is we've actually branded C-class product internally in our in our investment committee meetings. When myself, Kevin, and Jared are meeting, we're like, do we have another hot potato on our hands? And it really is a hot potato, because what you do is you step in, you do the value add, you increase the rent, and then you sell it as fast as you can, because you can't go through a single cycle of lease turns because the tenants break stuff. So in a B-class project, I mean, we got our what we call a PCA, which is a property condition report from our lender, who sent out a third-party appraiser to do the property condition report, and we got it yesterday. And what's amazing about it is they're saying we need to budget $250 to $300 per year per unit as our turn cost. Now, when you're doing a Class C project, you've got to budget $3,000 to $5,000 per year for your turn cost, because they simply break stuff. It's just the quality of tenant that you have, that when they turn, if you have to evict them or they leave on bad terms, they just break your unit, and you've got to go spend $5,000 renovating the thing. And there goes your cash flow, there goes your returns, there goes everything. So our secret sauce here is to compound the power of 5 waves. So there's a massive trend towards multifamily living. As I was saying, is the freedom of choice that it's giving the baby boomers. What tends to happen is they've owned a property for 30 years. They had 2 or 3 children. They now don't need to live in a big 4 or 5 bedroom home that's worth $1 million. So they sell that home, and then they move into a nice apartment where they don't have to mow the lawn, they don't have to clean the pool, they don't have to fix anything. They just want the freedom to be able to come and go as they please without having to worry about maintenance issues for their homes. So there's a huge trend in that particular movement. And then the other side of it is millennials, who are earning reasonably good money, but they've got massive student debt against them. So they're starting their kind of family married life a little bit later on in life. And then they're also, because of the mentality in millennials, is they like to have freedom of choice, and they like to have optionality around where they live. And if they do need to be able to move jobs or whatever the case may be, simply cancel a lease and move to another place and start a new lease. It's creating a very big trend. Scott, do you want to ask a question?
No, not far away. I'm putting up some of your nice slides and teasing people on WhatsApp and Facebook.
Cool. Okay. So then cap rates are trending down over the long term. What's very important here about cap rates, and I'll show you the calculation in a second so that you can understand it, is the cap rate is the capitalization rate of the property. So it's effectively the yield that it would be if you didn't have any debt on the property. So if we bought a property for $1 million and your yield was $100,000 a year, that would be a 10% cap rate, because the income is 10% of the total project price. What's amazing about it in multifamily is the income drives the value. So if you've got a cap rate that goes down, is it effectively pushes the value of the property up. And because cap rates have been trending down, what Scott showed you a little bit earlier, some of the graphs that I sent him yesterday, is cap rates in B class and A class and C class properties have all been trending down over the long term. And B class stuff is trading across the US at around a 5 to 5.25 cap rate. And we're buying this project at a 6.25 cap rate. So you can imagine the inherent discount we've got in from day one. Then rents are trending up because of inflation and supply and demand imbalances. Vacancies are trending down, and if you've got diversification of income, so if instead of if you've got $10,000 to deploy, you could go take that $10,000 and put it down as a deposit on a property in South Africa, and you would own 1 unit. But if that one tenant doesn't pay you for any length of time, you've got to plug the hole and pay that money in. Or you could take that same $10,000, generate income from day one as if you bought a property in South Africa, which you couldn't get income in because it would be negatively geared, but you'd have 180 or 200 or 800 tenants paying you a piece of that rental income instead of one. So if 40 tenants or 50 tenants don't pay, you don't lose your money. That's what's most important here. Diversification gives you lower risk. And then how we hunt the outsized returns is simply buy at a good price with clever negotiations and proper structuring. Inefficiencies in management, so we want to see that we can maybe do something a little bit better with the management to save on some expenses. How we sometimes purchase properties gives us a bit of an advantage in management. Can we get insurance under an umbrella insurance package instead of under one particular property? So the way we're buying our 800 units now is it actually goes in under an umbrella insurance policy that's got 4,000 units in it. And because we're under a 4,000 units policy, we're getting a much better rate than if we were just going in and taking insurance out on one particular. That's just an example. We want to find it a little bit under leased on this particular property. It's already stabilized, but if we can increase the occupancy, obviously we can increase the income. If we increase the income, we increase the capital value, and we increase our distributable cash flow. We want to find a trailing market rent per square foot. So if we can increase the rent, obviously if we're the cheapest stuff in the market and we've got space to move, and then we're looking on day one whether we can distribute 7 to 8% cash flow without having to do anything. So if we didn't have to do anything and we got 8% per year no matter what, then that's a great outcome for us. And in terms of an internal rate of return, if we've got benign rental escalations of 2 to 3%, which is CPI related, we can exit with a 14 to 16% internal rate of return between 3 and 6 years, then that's a great outcome for us in terms of a risk-adjusted return. And then with great debt that we can get interest only to increase the cash flow for the first 2 to 5 years, then that's what we take up. And this is very important. The debt piece is the property portfolio I'm going to show you now. We're buying for $75 million. I'm not sure how many people can sign for a $52 million mortgage bond, but we're able to bring that to the table because of the sophistication of the deal, and that's part of the value add that we bring that most other people can't access. Even if you had the $25 million to go put down as a deposit, you couldn't access the debt unless you had a track record of 20 years in the market, unless you could show them proof of funds, unless you had 4,000 units under management. Morgan Stanley won't give you the debt if they don't know that you can operate the property. And the magic
Brendan,
is...
just a quick one. Sorry, Brendan, just a quick one there. A lot of people have heard me talk about this, but I always talk about OPM, and a lot of people think OPM is other people's money because that's what we've all been taught. I think that there's a new concept now, which is other people's mortgages. And what that means is that if I go to America now, it doesn't matter if I've got $100 billion in the bank. If I'm not an American citizen, it's virtually impossible for me to get finance. And if I don't have a track record, there's even less chance. And what you've done here is, get good access to, affordable capital through Morgan Stanley based on partnerships and track record and everything else. That again, no matter whether people are ranked beginners on this call or some of the wealthiest people in the world, it doesn't matter. And that's why this model is so powerful based on partnership, because you get good deals through partnership. So sorry, I just want to.
And what's amazing about it, Scott, is this is what the wealthy people do. When I'm saying the wealthy people, I work with some of the wealthiest people in South Africa. We've already, we've bought a lot of property in the States. We're nearly fully funded on this particular deal, and the wealthy people are leveraging other people's balance sheets and simply supplying the capital with zero risk. So if they don't have to sign for a mortgage, their balance sheet is not on the line. They never need to worry about covenants, and are they going to be on the hook if something goes wrong with regards to the loan? We've got a partner that stepped up to that, and he signs for all of that, which means you've got zero risk on your balance sheet for a very big loan. It's a phenomenal value add, and the very wealthy people get that, which is why they're deploying millions of dollars with us. So when you look at the hard work, I mean, this is really what we do. We build the network, the partners, the investors, the legal, the tax, the lenders, subcontractors, staff, everybody that puts an entire deal together, and we require everybody. Our power is in the collective team that puts this entire thing together. We build a track record, we source the deals, which is an important point here, because deals don't land in your inbox unless you have a great track record with ability to close. So oftentimes you'll be bidding against somebody, and there's a lot of syndication networks in the States. And the reason we win good deals is because they can look at our track record and our partner's track record and see 20 years of not messing sellers around. And when you've got hungry capital looking for places, they're not looking for the best price. They're looking for the highest probability of closing the deal without any headaches. When somebody's selling a $75 million portfolio, he doesn't want to be back on the market 3 months later or 4 months later because the buyer messed him around and canceled the deal because of some stupid thing or try to retrade the deal, or didn't have the money because he said he had the money or something like that. So they look at your track record and say, okay, what's your probability of closing? Okay, now we can work with you guys. And very wealthy people can land in the US with a very big balance sheet and still have zero deal flow because people don't know of their ability to close, ability to move money around the world. With Reserve Bank regulations and capital controls and that type of stuff, they want to know, what's your probability of closing? We run full legal compliance, full due diligence, and I'd like to just show a little bit about the due diligence process, for example, so that I can teach you what to look for in a deal, so that you can be a little bit more aware of the level of detail we go into when we're looking at a project. I mean, we're talking about, let's have a look at my due diligence chart over here. So this is the 5 properties that we're buying right now. So we've got all the lease files made available, the tenant ledgers. So now we want to be able to see the history of those tenants and match them up against the leases. We want to see the delinquency report. So how many of those people are paying on time? How many of them are paying late? And what we do is we run an analysis where we work out what percentage of the tenants are paying within the first 7 days of the month. And then that's what we use to work out what our cash flow distributions are going to be. And what's great about this property, particularly in Oklahoma, is tenants have a mindset or a philosophy of payment because of the strict laws over there. If you go to the judge and you say, well, look, this tenant's not paying, and he asks a couple of very simple questions. Okay, did you pay? And the tenant says no. He says, are you going to pay? No. And then he says, okay, be out on this date. So it's very, very simple. We've got all the revenue share agreements. So this is contracts like, for example, if we've got a laundry facility on site, and the laundry facility is run by a third-party operator, and we're sharing in the revenue, maybe 50% or whatever the case may be. We get all of those agreements. We go through that. All the maintenance logs, service vendor contracts, the list of vendors so that we know who we're working with, all the capital expenditures that's been done since the seller owned the property. What's nice about the properties that we're buying now is they spent more than $6.5 million on all the renovations to the externals of the properties. They fixed leasing offices, repainted all the buildings, fixed the tarmac, they fixed all the amenities. One of them built a brand new pool. So they really spent a lot of money in all the stuff that doesn't create income. It's very, very important. We could go and do a renovation of an interior of a unit and boost the rent by maybe $100 a month. They didn't spend money on that stuff. They chose to spend money on the capital expenditure stuff that doesn't create income, which is great for us because we can step in now and not have to spend any money on the properties for the next 5 years. Major mechanical records, insurance policies, reports related to fires, storms, accidents, other casualties, all the operating statements. This is massive. If you can't confirm that the income is real, and I'll show you how you confirm that, this is the process, guys. So I'll take you through. Here's the due diligence folder, right? So we go into due diligence stuff. We'll go pick one of the properties and we'll see here's all the due diligence stuff. We've got bank statements, utility bills, environmental reports, property condition assessments, rent rolls, the employee info, the title insurance stuff, the land surveys, everything. Then we go in here and we say, okay, let's go look at an operating statement. So we go look at the trailing 12 months operating statement. We open it up and we see, okay, here's the income that they tell us on this particular property. So we go down and see, okay, our net operating income and our expenses are, as our net operating income, it's $1.9 million for the last 12 months. Then what we do is we go and compare that to the bank statements. So it's a process, guys. This is part of the value add that we bring, is we go to the bank statements and we pull them all up for the last 18 months and we see, okay, do the financials match the bank statements? And then as long as we're within about 2.5%, because they've got sweep accounts and mortgage payments and all the rest of that stuff. So it's never going to match exactly to the cent. But as long as we're within 2 to 2.5%, we know that what they're telling us is real. And this is very important, people. If the income's not real, don't buy the property or negotiate or change the price, whatever. Find out what the real income is so that you know if you're getting the value that that you think you're getting. Then the other key factor here is your real estate tax bill. Very important. When you're buying a property, they're going to reset the tax basis up. So let's say they bought it for $60 million and we're buying it for $75 million. We're going to have the $75 million amount that's going to be used by the county to calculate our tax bill, which means it's going to increase the tax bill, and I need to take that into account in our cash flow forecasts to ensure that we still have the income that we expect as a result of that. So we go through all of this stuff, the floor plans, the most recent environmental site assessment reports. Very important to go through the environmentals, especially if you're in or close to industrial areas where there might be leakages or there might be another property that's influencing your property. So we go through all of that stuff, the rent rolls, and how we run this stuff generally on 827 units. We walk every single unit. We build out a capital expenditure spreadsheet related to each unit. We then also analyze every lease against every unit. So it's a very in-depth process that takes us about 3 weeks with a team of 8 people to run on 827 units. And I personally read about 10% of the leases, and I spot check what the team produces as the report. And obviously this is the summary of everything we received. So part of our purchasing criteria is we have to receive the due diligence from the seller, and then we go and tick off what we received, what we're still outstanding, because our due diligence period starts ticking as soon as we've received all of the information. So that gives you a little bit of insight into what you should be looking for when you're underwriting a deal. Now I'd like to go back to my presentation. Let me just find it here quickly. So we do the hard work. We find the deals, we negotiate the terms, we negotiate the deal, we get the sponsor on board, we bring the debt, we help people move money if necessary, and then we partner with people like this. So we're buying this portfolio right now with in conjunction with Ferndale. Alon Jonathan is his name. He's been buying property in the US for about the last 25 years. He's an ex-South African who moved there when he was 12 years old. And the reason we were able to access deals through this is we're very good friends and business partners with his cousin in South Africa. His name's Greg Friedman. They own Spartan Truck Hire. So if there are any South Africans in on this webinar, you'll know Spartan Truck Hire. It's the biggest logistics company in South Africa. And they've been investing in multifamily with Alon for the last 7 odd years. Here's some of his track record. $250 million in assets under management. And he's been buying for a very long time. This is just some of the projects that he has. and the amount of units that he's got. And this is very important. Without this track record, we can't access the debt. But at the same time, it's quite a simple, logical thing. Without that track record, how do you expect somebody to be able to operate a property efficiently? Because like you said earlier, Scott, it's the skills of the people that you're partnering with that determine the success of a property. Just buying a property is 20% of the work. Making the property work consistently for 5 to 10 years, that requires somebody with a level of skill and detail orientation that is unprecedented most of the time. And if we can find those people and partner with them, it makes our success much, much, much faster.
Yeah,
so
well,
here's some of the,
that's why I say you're investing in the partner, not in the property.
Absolutely. So I want to show you something phenomenal. So we're buying this property right now. It's a collection of 5 assets in Oklahoma and Tulsa. It's 827 units. It's 96% occupied. From day one, we'll be able to distribute out 8% cash flow to investors. From the day that we own it, we pay out quarterly. So if we close on this at the end of September, we're closing on the 27th of September. The first payment will be in January.
Brendan, just a quick one. We're not giving people financial advice here, but what we are doing is taking them through an existing deal. So we're not just having a hypothetical conversation. And if people like this deal, then they would be able to make their own financial decision based on the information and the due diligence.
No, absolutely. I'm using this as an example to crystallize the thinking and the education that we've been through earlier. This one is already like 99%.
I just want to point that out. As you just said, it's closing at the end of September.
Yeah. And it's a great one for everybody to see the theory played out in practice.
Can you put your slides, I don't know what you call it, slideshow on, because we're actually just seeing your screen, but versus actually PowerPoint, yeah.
Okay, there we go. That's better. So there's some of the parameters of the current deal, but what I wanted to show you is the power of a very simple deal strategy. So I want you to be able to leave here with a strategy to be able to deploy on your own. And I'll just pull up a spreadsheet for a second and say, okay, is if we're going to buy this property now, as an example, and we're putting down a $24 million deposit roughly, and our 8% cash flow distribution is $1.9 million a year, and we hold it for 5 years, effectively you're going to have $9.7 million back in your bank account if you were putting down the entire amount of money on this particular project, which is 40% of your capital back within that 5 years. But here's the real magic. The real magic is we've got 827 units, and we have to ask ourselves, while we're collecting this cash flow, and the cash flow is really the thing that creates our freedom, but at the same time we want to know what's our capital upside probability. And if that happens, that's the cherry on the cake. If it doesn't happen, I'm just happy to collect my 8%. So I'll make my decision on the 8%, is it real? But then I look for, how am I going to make real money out of this thing? So if we've got 827 units and I can increase the rent by $30 a month, which is nothing. Nobody moves for a $30 per month increase every year. So if I can increase the rent by $30 a month once a year across my 827 unit portfolio, and I'll hold it for 5 years, so I end up with an average of $150 rental increase per unit in the 5th year. What that does is it creates $124,000 a month more income. And our expenses generally don't change that much because we've got our debt fixed. Our debt's fixed at 3.8% right now for 10 years. So we know our debt's fixed. We've got no surprises over there. Our expenses are more or less fixed. Our staff, our infrastructure, our property taxes, our insurance, we know what they're going to be. So if we can increase our income by $124,000 a month, which is $1.4 million a year at a cap rate of 6%, that gives you, so you simply divide the $1.4 million by 6% in order to give you the value upliftment. You can see we're creating $24.8 million in capital upside out of this property on top of the cash flow by simply increasing the rent by $30 a month. This is not a fancy strategy. What we can then decide in 5 years, do we refinance and take all of our equity out and continue to hold it? Do we sell and take the profits? What do we do? But if we've got $25 million roughly in capital upside, we have the choice to be able to do a lot of things. If we look at the choice and we say, well, what if we don't sell and we increased our distributable cash flow from 1.9 million to $3.4 million a year, we've now got 14% cash on cash. So this is the percentage of income against the capital that we deployed. 3.4 million divided by 24 million gives us the 14% cash on cash. So I'm happy to not sell, ride out a wave, and simply collect that income indefinitely, because where else are you going to get 14% in dollars cash on cash every year without having to think about it? So on a risk downside is if our income stays the same, we're collecting 8% a year. If our income goes down, what's the position we're going to be in? So in the last recession, in the multifamily sector, generally vacancies increased by about 4 to 7%. And so let's say you were operating at 95% occupancy, you could expect it to drop to 90% to between 90 and 88%. Then rents dropped by around 5 to 7%. So you could expect a combined impact of vacancy and rent drop to be around 15% on the worst case scenario. So if we took that and said, well, what if we doubled it? And we said we could lose 30% of our income. All that happens is we lose this 8% distributable income, but we don't lose the property and we don't lose our capital. We can continue servicing the property, servicing the debts, paying all the staff, everything if we lost 30% of our income. For me, that's a phenomenal position to be in terms of risk, because I know that I'm not going to lose 30% of our tenants, which is why we invest in every single deal that we do in multifamily space. Personally, Brendan's putting in a large stake of his personal wealth into this property because I love the income it can produce. The potential for upside is I can double my money in 5 years, and the potential for downside is negligible, because I don't expect us to ever be in a position through the worst financial crisis in the history of the US since the 1920s. The reset in multifamily was around 15%. So if I double that and say, well, if in the next recession it resets by 30% and I still won't lose the property, then I'm game. Then I'm in for this property all day long, every day. So that's what I want to leave you with today, is the probability of downside. We've got a great property, and thank you very much for your time. So
just go back to that page quickly, the one that you had with not the spreadsheet, the one before this, the slide before that.
This one.
Yeah. I just wanted to point out down the bottom that on this particular deal, they're looking to raise about $23 million. They've already had more than $21 million committed. And when they deal with new investors, they only deal with people who are willing to invest $1 million or more in terms of that process. Now, just to put that in perspective, because of the long relationship that we've had between Brendan and myself and Infinity and Migrate, we've managed to get a piece of the capital stack. So we've only got $500,000, which is not a huge amount, because obviously there's not a lot of time now running up to closing, which is the end of September. I think he said the 27th of September. And also what's exciting is that, as per the philosophy of Migrate and allowing the 99% to be able to invest like the top 1%, obviously $1 million is a significant barrier to entry, whereas we're allowing people to participate from $10,000 in terms of this deal. Now, normally on a WealthE Wednesday, we even drop it to $1,000, but there isn't a WealthE Wednesday between now and the closing of this deal. And so the minimum is $10,000, but that's a long way off $1 million. And what I'm going to do now is I'm going to share with you a link. So if you don't mind, Brendan, is there another slide you wanted to share quickly, or can I share with people a link basically?
No, you can take it back, Scott. I'm done. I just wanted to share pretty much everything like that. Our philosophy, the reason why we buy what we buy, how we underwrite it, the level of due diligence that we do, and I think I've covered all of that. So anything else in terms of timing, people can just ask questions and we can go into those, but you can take the screen back. Absolutely. Thank you.
So what we've done, just to make it easy for people, is we've got a little landing page. So you can see it's wealthmigrate.online/infinity. I will put that quickly in the chat box just to make it easy for people. So it's in the chat box for everyone. And you can literally just go in and put your name and number in there. This is for people that don't already, not already KYC'd on the platform, just so that you can express an interest. And then, one of the team members can get back to you and help you. If you are already on the platform, you can literally just go to Migrate. I think I was here. You just go to wealthmigrate.com and you can literally go into the deal. And if you KYC and everything, you can literally go and pledge and go. It is on a first come, first served basis. So I'll just go back to this page here. What I'd like to do is, everyone's time is very valuable. There's a whole bunch of questions. and your time is as valuable as Brendan's and mine and the team's. And so I just wanted to ask a couple of questions, while we're running through some questions here. And if you don't mind, there's some polls that are coming up on the screen, and the more you answer the polls, the more accurate we can actually help you in terms of making sure we give you the right information. So you can see, we've asked you the question, do you think investing in the USA makes sense? And, I'd really be interested in what your thoughts are, if I just give it 30 odd seconds. Brendan, one of the people asked, and I think you answered the question, but I think it's worth repeating. They said, what happens if interest rates go up? How do you manage that? And you did talk about fixed cost of capital, but I'd love you to refer to it a bit more, because obviously in countries outside of America, it's unheard of to be able to fix for 10 years. And so obviously a concern is always what happens if interest rates go up,
Yeah, exactly. I think it's a great question. So well done for asking. So one of the things that we do pretty much on every deal is we fix the rate for as long as we possibly can. And most of the time, it's a testament to the quality of the deal, how long the lender's willing to fix the rate for. So on this particular deal, our lender is very much a partner in the process. I mean, they're providing $52 million. They vet the deal very, very thoroughly, and they want to make sure that they've got the ability to get paid their money back. So when they underwrite the deal and they say they're willing to give us a 10-year fix, it's a testament to the quality of the deal. And then, so I would say if you can fix we're fixing debt at sub 4% interest rates with interest-only period of between 3 and 5 years, which is phenomenal. And it's a risk diversification, or a risk, you're taking that risk into account. You don't want to be in an interest rate increasing cycle with a floating rate, and all of a sudden because what tends to happen in interest rate increasing cycles is obviously your value changes, because the property prices would change if interest rates are going up. The spread between your cap rate and the interest rate obviously gets squashed, so there's less income, and as a result, in order for people to reset that, they lower the price of the assets. But if you've got 10 years to ride that wave out with a fixed interest rate, and you know what your income is, you've suddenly removed that risk completely.
Right. Tell me, in terms of, you've answered this already again, but I think it's worth, there's a question here. Why multifamily?
So what's so amazing about multifamily is,
why multifamily compared to other asset classes?
So it's if I had to simplify it, really, it's about human beings physically being this size. So it means it's non-disruptable. You still need a place to live, no matter what happens in AI or technology or blockchain or anything. Like, you still need a place to live, no matter what. Which then means if people still need a place to live because they're physically the size that they are, there's always going to be a certain demand for accommodation. And if you're providing accommodation at scale, what's important here, multifamily at over 100 units provides the ability to employ people on site for management. If you're at 22 or 25 units or 44 units, you don't have enough income or scale to employ permanent staff on site, because you're too small to pay the 2 people, because you need a maintenance person and a leasing manager. And they cost you $10,000 a month for those 2 people, which is $120,000 a year. If you're working in $1,000 to $2,000 a month increments on rental income, and you're at 44 units, you don't have enough inherent income to employ good quality staff on site. But as you start going over 100 units, now you've got the economies of scale in your favor to employ great staff on site, to always be available to be able to service your tenants, which means you've got great service on site with good quality staff members in a leasing office, so you can collect rental income. Another important thing here is rental collection. So if they've got a place to go, a leasing office where they can go and hand in their money order, or do an online payment, or talk to the leasing manager every single day, they can't hide. So it's easier to manage, it's better to manage, and the only way you get that is if you're in multifamily at over 100 units. So it's about risk diversification, income diversification, economies of scale. And when you compound all of those together, and you realize the reason why multifamily is the most resilient, the most traded asset class in the world, and the biggest commercial real estate class in the world, it's because of those reasons. The wealthy people are investing in it. The insurance companies are investing in it. Freddie Mac, for example, you showed that document earlier, they're the biggest lender in it. And why would they be lending on those assets? Because they know their money's safe, because there's enough income consistency to always pay those mortgage bonds. And that's really why multifamily It's resilient and it always produces income. And I'd much rather have 800 tenants paying me an incremental amount per tenant than have 1 or 2 tenants paying me rent when I've got to go hunt for money when one of them doesn't pay.
I think the other thing is, again, from an economically resilient perspective, Brendan, when they had the last crash, properties lost anywhere from 40 to 70%, depending on what city it was in America. And mainly that was single family houses and quite expensive condos. And what interesting is all those people sort of suddenly became multifamily tenants and,
Exactly.
and it actually compressed the sector. And what was really interesting is that during that time, I mean, in 2012, when, like we said, when we were there, we were trying to buy multifamily apartments. I mean, you and me and Henny and others walked numerous buildings. We just couldn't get any offers accepted. It doesn't matter what we wanted to pay.
We had no track record, and it took us years to build it.
We can now do it, in terms of that process. So there's a lot of questions here, and I want to try and fly through them. I'm conscious of people's time. Martin said, will you give us a word about Delaware LLC and offshore? I'm not really sure what the question means, Martin. I mean, obviously people, set up LLCs. We've done them in multiple different states. Delaware tends to be one where people like to do it from an offshore perspective, but I don't really know what the question is, to be honest. I don't know, Brendan, if you've got any insight into it.
No, it's probably a structuring related question, and look, that one we can definitely take offline. We can't give any financial advice or structuring advice or anything like that. I can tell you what we're doing in an offline scenario. This is just from Brendan's personal perspective and how I'm structuring my stuff, but absolutely go and seek out third-party stuff. Well, what's phenomenal about the platform is they don't have to think about that stuff. You've already done it for them. So if somebody's going to go and log in on Wealth Migrate and invest in this deal, it's already taken care of. So so you can go into the platform, commit your money, and you don't even have to think about that stuff.
Yeah. That's why we take away that complexity and make it safe and simple. So Martin said you have to shelter our investments under a REIT or something. So again, Martin, in terms of the structuring and tax and all that, that's all taken care of when one goes through the platform. In terms of that. Question for later from Andre. So Tabogo said, well, how do we get on the WhatsApp group? So it's for the Inner Circle. I'll put a link in if you want to join the Inner Circle, but it's our global community of people that participate, learn and grow together. Andre said, a question for later, through your platform, how much money can you move at a time or during a tax year? So if you're from South Africa, you can move R1 million per year as part of your discretionary allowance, or 10 million rand you can apply per person per year. So I mean, effectively per adult over 18 in South Africa, as long as your tax affairs are in order, you can move 11 million rand per person per tax year. Ian has said, is the corporate tax rate 21% fixed, or will it be affected down the line if Trump is not in power?
Who knows? So the Democrats would probably change it if they come into power. But you make decisions based on the information you have at hand at the moment, and it would take quite a lot of work for them to change it. And while it's in play, I'll simply enjoy it. But the key factor here is I actually don't even worry about that stuff, because I'm always doing either a 1031 exchange or reinvesting or something like that. So I have no intent of ever really having to pay that 21%, whether it's 21, 35%. My intention is to grow my portfolio and grow my after-tax cash flow, which means I'm never going to be in that position.
So quite a few people are complaining, Mark, Martin, Al-Marie, Mohammed, about the $1 million minimum investment. Obviously, Brendan deals directly with investors one-to-one, and primarily being high net worth and even family offices through Wealth Migrate, and through our partnership, people can participate from $10,000. If you are part of the Inner Circle, you'll also be able to participate from $1,000. So really letting people get far access,
Yeah, that's important. Sorry, that was on the slide there, that the minimum from our side was $1 million, but we've made that open on the platform now for everybody from like $10,000. So this is why it's so unique for everybody to be on here and have accessibility to a deal at this level of sophistication through the platform with a barrier of entry as low as it is. And to be fair, guys, Scott fought hard to get it on the platform because we've got some very high net worths we could raise out the balance without having to do this. So it's not that we needed to make it available, it's that we wanted to make it available to everybody so that we can really bring the vision of what Wealth Migrate's about, which is democratization of deals. Like why should only high net worth people with $1 million be able to afford to participate in this and not everybody else? And I think it's a very valuable service that he's created. So if you are thinking about investing,
we've got an entire team of people. So
absolutely. But I mean, you're the sort of head and face, but I know behind the scenes there's an entire team to make it happen, and it's phenomenal to have this access, guys. This is the behind the scenes deals that most people would never have been able to access 5 years ago or 10 years ago, unless you were part of a very elite group of inner circle wealthy people, and the deals would never see the light of day.
Keith has said, when I log in, it says I can't invest because I'm not an accredited investor. Will you be making Wealth Migrate available to US investors? So Keith, we are working on a broker-dealer arrangement. Because of the SEC and regulation, we need to separate what's available to US citizens and non-US citizens, so it's a little bit more complicated. If you want to message us offline, we can see what we can do. But it is much more complicated for unaccredited investors in the US. You need to go through a broker-dealer. Okay, lots of people complaining about the $1 million.
I hope we've covered that.
Clearly we've touched a sore point there. So for Mohammed and Martin and everyone else, look, with our digital wallet solution, we're looking to bring it down, even lower and lower as the technology becomes more and more efficient. But for now, based on where the deal is in closing, you've got the details. Leon said, what about the implications of a USD crashes? I don't know if you want to answer that, Brendan.
So, I mean, this is macroeconomic stuff. We've got to ask ourselves a couple of fundamental questions. So it depends where your money is coming from, what risk you have on where it is coming from, what you're transferring into, what's your general portfolio. But from a macro perspective, like the US is still the world reserve currency for trade. They're very dominant in terms of military. They're very dominant in terms of buying power. They're very dominant in terms of global political power. I don't see their currency crashing very soon. It would take, to turn a ship of that size takes a very, very long time. And you can have all the disruptable kind of technologies coming in, like blockchain and cryptocurrencies, and China trying to devalue its currency or take over the world trade and that type of stuff. It's still going to take years and years and years for that stuff to play out. And in the meantime, if I've got 800 tenants paying me $1,000 a month with fixed debt, it's not really going to change from their perspective. They're still going to have a job. They're still going to pay. They're still going to, pay us income. And if the US dollar changes and that currency thing changes, and we now have to look at the world in a new light, we're all going to be in pain if the US dollar crashes completely. And then we'll look at the world in a new light in that particular time period.
Perfect. And yeah, my thing that I would say is, being ex-Zimbabwean, the entire economy crashed. The currency had record inflation around the world. And what was really interesting is that back in 2000, 2001, I got hold of my uncle and said, I want to come to Zimbabwe and buy houses. And he said, why? And I said, no, there must be a huge opportunity. And he said, no, because everyone still needs a place to live, and the value of houses in US dollar terms actually went up. And so, even if the US dollar completely fell apart and people had to pay with cats and dogs or donkeys and carts, they're still going to have to pay with something. And that's one of the things that makes, houses, I always joke, houses and hospitals so resilient. And when I mean houses, I mean accommodation.
That's it.
Do you pay tax in the USA or South Africa on your income? So again, there is tax through the corporate structure, and then you get a net return. And then depending on your tax status around the world, you would need to declare depending on where you're tax resident. Again, we can't give tax advice because it's individual to every single person. But you do, in terms of the returns, you're seeing a net return basically. So Martin wants to put 100 investments, $100 into 100 investments and pile them up over time. So Martin, very much the intention. And as we get the digital wallets, which are now hopefully, weeks, 4 to 6 weeks away, these things will become a lot more effective and efficient, just in terms of making that happen. Please send us the recording. That's perfect. It will be recorded and we will share. So yes, people will be able to access the webinar. we're not US citizens, how and where and how much income tax per year will we have to pay? So again, that's as per what I just said in terms of where, depending on where you're a tax resident. Matabello said 1 million isn't available to everyone. Completely agree with you. Matabello, many years ago, I was buying hospitals. I met two very wealthy people that were buying hospitals, and they basically said, this very common sense thing, and I thought, right, I want to participate in that. And it was 5 million Australian dollars, and I couldn't participate. And this is exactly why we built Migrate, because previously to invest with Brendan, you needed $1 million, and now people can participate from far lower minimums, which I'm really excited about and very grateful to Infinity for giving us the opportunity. Is the 8% taxable in South Africa? So Leon, as I said, it's you would pay your tax. It's a net return in tax, and then as a tax resident, you would declare your tax around the world. Please give 20 of us this opportunity at 1,000. Mohammed, I'll give you 10 out of 10 for perseverance. As I said, for people that are part of the inner circle, we can definitely look to find a way and reach out and speak to the team, so that we can let people participate. What I'd suggest is, if people want to, they can literally go onto this landing page. You can see there, it's wealthmigrate.online/infinity, and you can literally put your name in and what you're looking at, or you can literally go onto the platform and you can, if you've done your KYC and whatever, you can literally register. I just want to finish with a few slides here, which I think are relevant. A number of people, over the years have asked me. I know Brendan has the same problem, where a lot of people want to sort of sit down one-to-one. I'm not allowed to give financial advice, but I have been helping people. I've helped thousands and thousands of people from all over the world, and so we do offer a service where people can pay, and I can actually sit with them one-to-one, and we can, look at their situation. I can't give them financial advice, but I can give them my experience over the last 20 years in terms of what's happening. So if you do want to do that, you can reach out to the team. There is a charge for that, because obviously my time, like your time, is extremely valuable. But that's for more high net worth people that really want to, create their long-term, solution. In terms of the next steps, you can literally go online. I've given you the link, wealthmigrate.online/infinity, or you just go to the platform, wealthmigrate.com. I always say sign up, start your journey to investing, and join our global community. And I specifically use the word learning because we're all learning. I learned a lot tonight, and I really value what Brendan shared with us. And the bottom line is, if you're watching the recording, you can click on the link below. And I wanted to finish. This is a picture of my son. He's 5 years old, and he's playing Monopoly, and he's learning that to own multiple greenhouses and red hotels and earn a passive income is very important, and it's what we call smart investing. His father, with an incredible team, has taken that childhood fantasy of Monopoly and now has a portfolio of residential and commercial across 4 different continents, and it's what we call smart investing. The wealthiest people in the world are not only interested in creating wealth, but actually in creating generational wealth. And that's really a lot of the things we've shared tonight. It's what we call smart investing. And our aim is to put smart investing in every single person's pocket. And yes, people are getting concerned about $1 million. Some are even getting concerned about $10,000. But I tell you what, we are making significant progress to allowing people to partner with companies like Infinity. I was really impressed, Brendan, by the level of due diligence you guys are doing. It's really impressive what you're doing behind the scenes. And, even some of the people on one of the WhatsApp groups I was posting were, saying some of their experiences with multifamily. And I said, well, multifamily, as you just said, is the biggest sector in the world. And just because one partner is not performing doesn't mean the whole sector is dirty, if that makes sense.
Absolutely.
And that's really important. Diversification across partners is equally as important. And, Infinity's got a very good track record, which is exciting. And I know a number of our investors have actually, consistently invested with you, and people that you and I have known for years from the buyers trips and everything else. And ironically, like you said, I've persevered pretty hard with you to get this platform, this property onto the platform. And it was actually some of our investors that were silently kicking me behind the scenes to make it happen as well. So thanks to them, for pushing us as well. But, from my side, Brendan, I just want to say a huge thank you. I also want to just acknowledge Lee and the team. They've done a huge amount of work behind the scenes. They don't always get the acknowledgement that they should, in terms of letting everyone know about this, setting it up, making it available. answering all the questions, etc. So Lee, thank you very much for everything you've done. I really, really appreciate it. I know, as you said, coming on live from Southampton, and I just want to make sure that you and your whole team of people, between Shane and Richard and Megan and Cisco and everyone else that's supporting you, there's a whole group of people, Alex, that will be talking to you tomorrow on the phone, or on the Slack group, the WhatsApp, the Facebook, the whatever. We're a tech company with a human face, and there's a lot of people that have participated in this to allow this to happen, and I just want to acknowledge them and say thank you.
Absolute pleasure. Thank you, Scott and Brendan. It's a fantastic webinar, and I'm sure that everyone got a lot of value out of it. So we look forward to chatting with all of you that have been online later on in the week. But as Scott has mentioned, if you have any further questions or that, please just send it through, and myself or one of the other team members will get hold of you and get those answers through to you. So thanks, everybody.
Thank
Excellent.
you.
And yeah, Brendan, from our side, thanks very much for your time. I really, really appreciate it. And for those people that are new and this is your first webinar, share it with your friends. I really believe that there's a new way of investing. Partners like Infinity impress me every day, and every time I go into more detail of what they're doing, the deals, etc. I just think it's extremely exciting that people now get to participate. And if you don't know about it, we've got live breakfasts in November. So around the 12th of November, we're going to do them in Durban, Cape Town, Johannesburg, and Pretoria. We're also going to run a wealth weekend for our sophisticated investors, where Garth and Hilda are going to be running a global workshop on a global wealth mastermind, which will be the weekend of the 15th, 16th, and 17th of November. Brendan and I haven't had this conversation yet, but maybe I'll twist his arm to be back in South Africa. And then also we always hold the wealth weekend, the Wealthy Wednesdays, and the next Wealthy Wednesday, obviously, it's always the first Wednesday of every month. And if I find it here, you can see the link. You can just go in and click on it. So you can see Wealthy Wednesday, October the 2nd. I'll put the link just quickly into the chat box for everyone. And every Wednesday, first Wednesday of every month, three things actually happen. One is that we run through all the deals, and so we actually did this with Brendan on the first Wednesday, just to more detail. We also, in the evening, we've got a lesson, so it's all about learning, and then we drop the minimum investments down. We drop the discounts to be able to get into the Wealth University products like the Inner Circle, etc. So it's just a day. It's like a Black Friday that we do every Wednesday to allow people to participate. So if you're interested in that, go along. Closing thoughts from your side, Brendan. Sorry, I've taken a huge amount of your time tonight, but there was so much we wanted to share, and considering hundreds of people from all over the world were interested, I thought we needed to put our A game on.
No, I think it was fantastic, Scott. Thank you for having me on. Thank you for everybody that came in, and I hope they took something home that was valuable today. Even if they don't invest with me, if they learned something, it's been a great thing, a great expenditure of our time. So thanks for putting it together. And also I just want to second it on the team side of things. I've worked with Lyndon and Mersha and Lee and everybody putting this together. So thanks to the whole team there for making sure that it happened, and to the investors that pushed you as well and pushed me to get it done. To be able to bring cool deals like this to the table for lots and lots of people is a passion that I know is close to your heart and close to my heart. So we both believe in it, and yeah, it's exciting. So guys, I hope you take up the offer and are in the position to be able to enjoy it, or if not, apply it to your own deals. If you saw some of the stuff that we go through on the due diligence side of things, go apply those to your own deals. Go learn how to underwrite them properly. Go make sure you find the right income, fixed debt, take the right loan to value, structure the deal correctly. There's lots of little things that we do to make sure deals are safe for people. But I hope you learned something valuable today.
Yeah, excellent. And for those of you who can't participate yet, I have just put up the thing here, which is our Inner Circle. I'm not going to talk about it now, but you can go and you can see the link there. Go and check it all out. You go to wealthuniversity.org, and you can literally go and read about the Inner Circle. And the whole reason we've done it is that it's by learning, by growing, mentoring, learning, growing, like-minded community. 80% of success is psychology, only 20% is execution. The challenge is being around the right people to get the psychology and knowing what the 20% is to execute on. So anyway, I think that's probably enough examples in terms of where we're at. So thank you to everyone who's been online, and really appreciate your time. And have a lovely evening, and please do go out and share it with other people. Let them know that there is the possibility now for people to participate. I'm tired of people living in a place of fear, and I really think we've all got a responsibility to share with them the abundance attitude, and that they can get access to good quality partners with good quality opportunities. And quite frankly, I think we've all got the ability now to take control of our lives and create the freedom we want. So thanks very much. Have a good evening and see you soon.
Good night, everybody.
Good night all.